No worries, no worries. All right, team, thank you so very much for joining us today. My name is Erica Cramp. I am the account executive here at EOI. We have educated our counselors not only on this exciting new benefit from CHUBB with the lifetime benefit term, but have also educated our counselors on all things hot topic. We have talked about the medical, the dental, the vision, and again, this brand new benefit offering from CHUBB. So just want to make sure that you all are aware that the services that we are providing, we will be able to log into the system. We will be able to help you complete your enrollment and answer any one-on-one personalized questions that you may have through your enrollment process. So we at EOI have put together some communication pieces to help those of you that wish to schedule a meeting. As you can see on the screen here, EOI is available for telephonic support. You can either scan the QR code that you see on the screen today. You can type in hottopic.mybenefitsappointment.com, or you can call us at 866-261-5885. We'll be able to assist you with any of your eligibility benefit related questions. So schedule a meeting today. So with that being said, again, I'm very excited to introduce Mark and Sarah from the CHUBB team to review the CHUBB lifetime benefit term. Mark?
All right. Thank you, Erica. Let me, it says I cannot start to share while the other participant is sharing. There we go. Everybody see that?
Yeah, we're with you.
Okay, cool. All right, so hello, everybody. My name is Mark Robin. I'm a business development manager here at CHUBB. We're very excited to be offering a new product this open enrollment. It's called Lifetime Benefit Term with long-term care. Before I dive into the the product itself, let's talk a little bit about the why long-term care coverage is needed. You know, when it comes to long-term care, we obviously can't foresee the future, but statistics, as you can see here, tell us that 70% of people over the age of 65 will need long-term care. I think probably more surprising is 40% of the long-term care claims that we see here at CHUBB are for individuals under the age of 65. When you look at all the claims, on average, we see about 92% of them lasting 3 years, which is where the extension of benefits rider, I'll talk about on a different slide here in a minute, that we've included will come in handy. But when you couple these statistics with the rising cost of healthcare and the fact that many states, including California, are looking at passing a payroll tax for long-term care, the need for long-term care coverage has really never been more important. And taking advantage of this open enrollment will give you not only give you a great benefit, but also give you the best chance to potentially opt out of any state legislation that's levied. So let's get into the product. So it's called Lifetime Benefit Term, and it's a 2-in-1 product which couples life insurance with long-term care. The policy pays a death benefit to your beneficiary upon death, or it can be utilized as a living benefit for long-term care. The long-term care portion pays out at 4% for 24 months or 25 months, and with the extension of benefits rider I just mentioned, you can receive an additional 25 months for a total of 50 months. So 4 years. As I mentioned on the previous slide, 92% of claims extend longer than 2 years. So this is an important rider that we've added included. Another feature included is can accelerate 50% of the death benefit amount if you were diagnosed as terminally ill with a life expectancy of less than 12 months. It's also worth noting that we do not have any pre-ex conditions clause that could potentially jeopardize you from receiving the benefit. Now we have a high guarantee issue this open enrollment, so I wouldn't play a factor anyways, but it's worth noting that we don't have any pre-ex conditions in our policy. With these products, there's a guarantee interest rate and a current interest rate that can play a factor behind the scenes. CHUBB's death benefit is fully guaranteed to the later of age 70 or 25 years of the policy being enforced. And at that point, it's guaranteed to never be less than 50% of the original death benefit. The good news is based on our current crediting interest rate, which is 3%, kind of into the minutia here a little bit, but it's 3%. The full death benefit is available to age 100. So in other words, there's no reduction. But I just wanted to point that out. Lastly, we do offer a reduced paid up benefit, which is pretty unique in the market. that fully vests after 10 years. So essentially what that means is after you've paid into the policy for a minimum of 10 years, and for whatever reason you can no longer make premium payments, you would have a reduced benefit amount that can never lapse, and it pays upon death or can be accelerated for long-term care. So after 10 years, you have a tangible benefit you own, even if you don't or can't make any premium payments any longer. So you own the policy. So this is really important. The product is issue age rated, meaning you will always be the same age in our eyes, and premiums will never go up. So it's issue age rated, guarantee renewable, and then rates do not go up. Additionally, it's fully portable. Should you leave Hot Topic for any reason, the premium and benefit amounts stay the same. You simply will move from payroll deductions to a direct bill with CHUBB. Okay, so a lot here on this slide, but the key takeaway you should have is the guarantee issue amount. So as an employee of Hot Topic, we're offering up to $150,000 on a one-time guarantee issue basis. Guarantee issue meaning no medical questions asked or medical underwriting. Anything above $150,000, as you can see, the max is $225,000, would require some medical questions, what we call simplified issue. Nothing invasive, blood, urine, or anything like that. It's just additional questions relative to diagnoses. Spouses can also elect this coverage, but they cannot exceed the employee election or the max spouse benefit of $112,500. So if an employee elects $50,000, they can elect $50,000, or you can elect $50,000 for your spouse. This would be done on what we call conditional guarantee issue basis, up to $75,000, and that's really just two questions. Those questions are, do you have HIV or AIDS, and have you been to the doctor and diagnosed with anything more than the cold or flu in the last 6 months? If no, then they can elect $75,000. If yes, then those simplified questions that I just mentioned for the employee would apply as well. Lastly, you'll have the opportunity to add a spouse on what we call our child term rider for up to $25,000 for any child between the ages of 15 days old and to age 26. This amount covers all children for one fixed rate. So whether you have 1 or 10, when any of the children turn age 26, they can convert to their own policy on a guarantee issue basis of up to 5 times the elected benefit amount. So if you elect $25,000 at age 26, the individual who now ages out can convert to their own policy of up to $125,000 on a guarantee issue basis. Okay. So how do you qualify for long-term care benefit? Is really based on a licensed physician diagnosis of the inability to perform 2 of 6 activities of daily living. These include bathing, continence, dressing, eating, toileting, and transferring, and/or severe cognitive impairment. Again, this is diagnosed by a licensed physician. The benefit is paid whether you are at a facility or your home, as long as it's administered by a licensed nurse. This is not a reimbursement policy. In other words, we don't require an EOB. We don't coordinate. We simply pay a 4% of the face amount monthly, even if that amount exceeds the actual expenses that are incurred for long-term care. Consistent with almost all long-term care policies in the market, there's a 90-day elimination period. So benefits will begin after 3 months or on the 91st day from the diagnosis, and premiums are always waived when you're out on claim. Okay, so as I mentioned at the beginning, we've included the extension of benefits rider, which adds another 25 months extra for long-term care. So a total of 50 months of potential long-term care coverage. So let's go over a few examples. Here's a snapshot of 3 different scenarios, all with a $100,000 face amount. So here's the first scenario. If you were to pass away and never use any of the benefit for long-term care, your beneficiary would receive the full $100,000. The second scenario, you're receiving a long-term care benefit for 12 months. So 4% of $100,000 is $4,000. Times that by 12, you're at $48,000. If you were to pass away during that time, your beneficiary would receive the full $52,000. Or if you came off or no longer needed long-term care, and you're able to perform those activities of daily living, you would be left with $52,000 remaining of long-term care coverage or benefit to your beneficiary. Third scenario, you receive 50 months of long-term care, so the original 25 months, so $100,000 paid at 4% for 25 months, and then the extension rider kicks in for another $100,000. potentially you can receive up to $200,000 for long-term care over a 4-year stretch. One thing to keep in mind though is after the first 25 months is exhausted and paid out, the extension of benefit rider kicks in, but there's no longer any death benefit. So if you exceed this 100,000 and you're now, were to pass away beyond that, there is no benefit to the beneficiary at that point. So anything above the original face amount before the extension kicks in would not leave any beneficiary money remaining. So okay, so as I mentioned at the beginning, many states are looking at passing a payroll tax, and California probably being the closest to rolling something out. The state of Washington was really the first domino to fall, taxing the residents a little over 0.5% of their salary. After being postponed, these deductions actually began on July 1st. So CHUBB's policy has an important distinction, which is called qualified long-term care. It's under a tax code, which is 7702B. I only mention it because it's being talked about as potentially being a prerequisite should the state of California allow for an opt-out for individuals who have private LTC insurance. And really any of the other states that are looking at it are utilizing this as kind of the baseline of being 7702. CHUBB definitely checks that box. So now, obviously, there's no definitive date set on when this will roll out or what the percentage could look like from a tax perspective. But again, enrolling in this product and having private qualified long-term care policy like the one being offered this open enrollment really does give you the best opportunities potentially to potentially qualify for any exemption beyond the reasons that we mentioned at the beginning from a percentage standpoint of the need for long-term care. So just quick recap, this is a 2-in-1 benefit that pays upon death or can be used for up to 15 months for long-term care. You have a one-time chance to enroll up to $150,000 on a guaranteed issue basis, which is super aggressive. I don't anticipate a ton going over that, but this is a high amount. It's issue age rated, premiums will never increase, and it's fully portable. You own the policy. And as I just mentioned, the 7702 component is important should an opt-out potentially happen. And that's all I have. Any questions?
Thank you so much, Mark. I'll stop recording, everyone, just in case you don't want your questions recorded.